Hey guys, what is up? It's Arthur here and welcome to this video in which we'll be taking a look at Tesla, their fundamentals, and see what the company is about and how are they likely to do in the future and whether there is any growth potential that we can take advantage of. So first of all, we have a 10-item checklist that I cooked up and we'll be going through them and see what Tesla scores, and I will talk you through the thought process here. So Tesla, $900 billion company, relatively large, huge company, part of the largest companies in the US. First things first, we want to look at financials, where all the good stuff is. And first of all, we want to take a look at their sales and revenue. We would want this number to go up, meaning that they can sell more and there is more stuff to do some good things with. Now this is a very nice even growth and we'd like to see that, so that is a check mark. We are up from 24.5 billion all the way to 96 billion, which is almost a 4x. That is very insane to see and a very nice growth. Tesla is thought of sort of as a growth company. I am not really sure how I feel on that. Tesla has been around for quite some time, and but we'll see if they have some more space to grow into, because that is the key question here, whether they can justify the valuation that they have now. Again, we don't look at the stock price because that is easy to manipulate, is influenced by a lot of noise, so we go by numbers and market capitalization or company value, because that's more reliable. Okay, next up, as you work your way down on the income statement, deducting all the costs from the revenue, all the cars that you sold, all the whatever Tesla sells, you deduct all the costs and you arrive to net income, which was negative 5 years ago, but we are up to 15 billion. Again, huge growth. So that is another check mark. Tremendous growth. And so now you can calculate the average of this. You can see it on the top right of the card that I just displayed. The average is 6.5 billion. So you can take that number and divide it by the market cap. So you get the PE ratio, which tells you if you buy the whole company right now. So if you pay $900 billion for this company, and this company earns you on average $6.5 billion in net income, how many years it will take you to get your money back. You can do this also with shares, where you do earnings per share and you compare it to the share price. Same thing, because you just divide and multiply by the number of shares, depending on the way you do your calculations. But that is a huge X, which is not a surprise really. Tesla has been known for having a very high valuation, and so for growth companies, this number might not be really relevant, like the PE ratio. I'm still on the fence whether Tesla is a growth company or not, because growth companies might have a negative, as you just saw here. It was 5 years ago, but growth companies might have negative net incomes for a long time as they try to build momentum and turn the business profitable. Tesla has done that quite a long time ago. So seeing 136 for a PE ratio just makes me want to scream and get out of here, but we'll keep on going and see how this evolves. Now, one thing that I included in this list that I think is new, that I haven't seen anywhere else be done, and I like it for the fact that I would like to show you guys and incentivize you, not incentivize, but to get you into the habit to go and look around similar companies. Like you have Tesla, you have General Motors, you have Ford, you have Toyota, Honda, whatever, all the different car manufacturers, Stellantis in Europe. And so what I do is that I go and take a look at their PE ratios and then compare to see how Tesla's valuation stacks up against the competition. And if you go take a look at that, the competition is 8.5 times, like 8.5 PE ratio compared to Tesla's 136. That is the price difference that you are paying for a car company. So that is a very, very huge difference. Now, moving on, 5-year average return on invested capital. This will tell us if you put $1 into this company, how much money they can generate. Market average is around 9-10%. Tesla scores 16%, which is actually pretty good and above the market average. This shows that they have some sort of sticking power or some following, which could be due to Elon Musk opinions change on that and vary on that, but it does have sort of a sticking power and a following, that is for sure, and that cannot be neglected. Also, the next thing I want to look at that I really like to look into is again on the net on the income statement below the net income, because once you know how much your business earns, you want to know how many ways you have to share it, how many other people you have to share it with, and you're going to see it from shares outstanding. You can do basic, you can do diluted. I do diluted because that is a more conservative approach, but you can see that we are up from 2.66 all the way up to 3.5, and the problem is that we want this number to be going down, but it is up 31%. Now this is, for me, sort of tragic to see, because what this means is that if you invest in this company, let's say you invested in 2019, you do nothing, and it five year passes, now we are up 31% in shares. That means you own essentially 31% less of what you bought. So even if you want to stay at the same level, you would have to put in 30% more money just to have the same starting point you started 5 years earlier. Now in other industries, they call it a scam. They call it here diluting you and issuing more shares. So this is something that I really, really don't like to see as an investor. So that is a huge X, and up 31%. That just, for me, I would be out at this point. But we also have to note that companies, when they issue shares, that means they are also, for those shares, they earn money. So you would want a company to issue shares when it's overvalued. That's a hint that what they might be thinking, just issuing more and more shares because people are buying it even though it's overpriced. They overpay for what they get. They might be thinking. And so on the reverse, companies would buy back shares when they think they are undervalued, so they also get a good deal on buying back their own shares, plus also you becoming a bigger owner of the business and your shares becoming more valuable because the company buys back shares. Now this is not good, as I said, but let's see what else they have. If you go to the balance sheet, I like to take a look at their ability to grow the business without taking on debt. And one way to look at that is to take a look at their long-term liabilities, which is not going to be listed because there is only total current liabilities, which are due within 1 year, and then total liabilities. Now you want total long-term liabilities, which is going to be just total liabilities minus total current liabilities. I have that calculated on an Excel sheet and fed up into this checklist. And you're going to compare the growth rate of that to the revenue that they have been getting. And so if you do that, you will see that long-term liabilities are actually down 8%, and they managed to grow the revenue almost 300%. That's 4x, as we told in the beginning. That is huge. They lowered the amount of debt and loans they have, yet they managed to grow the business by such incredible values. So that is a huge check mark, to be fair, and we gotta give them that. Next up, the cash flow statement basically is just cash coming in, cash coming out, and what's left at the end. You can get the free cash flow, which we are interested in, what remains at the end of the day. You can take net operating cash flow, column by column, and you deduct capital expenditures. You get the free cash flow. Market Watch lists it on the bottom, so you can see it here. We are up from about 1 billion to 4.3 billion, which is again a very nice growth to see. There was a higher year last year, which is actually 2022. 2024 data is not out on Market Watch. I think Tesla already posted it, so it's on their website. You can go look at it and compare the new values, how they stack up it. Maybe do your own spreadsheet on that and calculate what you see in this video, so you can let me know, and I will also do a video when that comes out, so we can compare them and share the knowledge between each other. Right, so this was a higher year. It dropped down. You got to look into why this might be. It's not in net income, but free cash flow is harder to manipulate than net income. So I tend to trust free cash flow more. So you would want to look at what happened here. I have a couple articles open, so we're going to take a look at that to hopefully try and decode some of this situation. You can also use free cash flow for 5 things. You can pay down debt, you can issue dividends, you can buy back shares, you can buy other companies or reinvest in the business. And once we know free cash flow, we want to look at how much time they need to pay down their debt. Now the average of these are 4.12 billion, and we calculated the long-term liabilities as I showed you how to calculate it, but I can actually show you the value. We can go into my sheet. It's in the balance sheet, and you can see total liabilities minus total current liabilities. You get total long-term liabilities. For the most recent years, it is 14 billion. They have 4 billion in free cash flow, which means it would take them 3.46 years to pay it off, which is a comfortable situation. It could be better, but still they can pay down their debt in 5 years if they decide not to do anything with it, which is not that realistic, but still is a measure to get an idea of how the debt situation looks like. Lastly, what you can do with the free cash flow is what you did with the net income. You take this average number, 4.12, and you deduct it, you compare it, not deduct it, you divide with the market cap. So you do market cap divided by the free cash flow, and that would give you, again, a ratio over 200, which is really not good, because what this means is that if you buy the whole company now or just one share, is the same thing. It would take you to over 200 years with the current rates, not factoring for growth, we will do that. It would take you more than 200 years to make your money back. Now that's not good. That's not good. Yeah, that's not good. There's just nothing else to add to that. But let's see. I also have, what else can we learn here? Tesla scores a 6 out of 10. So it's not terrible, but the X's are really, really big X's. So you got to do your research and see if there is a ways to justify those, or if there is a future ahead of Tesla. Let's see what we can see from a little dashboard that I made. First things first, market cap, enterprise value is lower than market cap, which is basically just market cap plus the cash, plus the debt minus the cash. So because it's a lower number, we know there is more cash in the business than that. So that is good. We also see that our profit margin, the average from the past 5 years, was 11%, and we are down to 7.3% in the past 12 months, trailing 12 months. That's what TTM stands for. And that is not good. We lost 4% of profit margin. That is not good. I wonder why that might be, but we'll see. In the past 5 years, they spent 221 million on acquiring other companies, which is not a whole lot compared to making 4 billion of free cash flow every year. So they are not buying other companies. It's probably reinvesting in the business, because they are definitely not buying back shares, instead issuing more. They don't issue dividends, so they either pay down debt or reinvest in the business. That's what they do with the free cash flow. And so what else we can do is we can look at some articles. Now, some related to the profit margin, some people say that Tesla is a tech company. Well, I don't know, man. A lot of car companies are within these profit margin ranges. If you take a look at Microsoft or Apple, their profit margin is around 35%, not a measly 7-10%. And you can take a look at, I have it open, you can take look at Toyota. We have a net margin of 11%. We have Honda at a 5.4 net margin. We have General Motors 5.9%. This is the same. So you can see, yeah, Tesla is more in line with other automakers. If you really think Tesla is a tech company, you could refine your analysis, taking a look at the revenue share that Tesla earns from software solutions, and then sort of you can like weigh the sources of revenue accordingly into your profit ratios or whatever. But this is, I think, accounted for, taking a look at revenue and then what is left of it. Anyhow, another thing to consider is that Tesla is worth $900 billion. So this goes to the valuation and whether this company is undervalued, fairly valued, overvalued. I do think it is overvalued from the fundamental side, so keep that in mind. There might be other angles to look at this company that could make sense. Well, I'm sticking to the fundamentals and helping you add that perspective to your view. So Tesla is a $900 billion company, and you can take a look at Toyota, which is a $250 billion. So essentially a quarter. So you can buy the whole of Toyota for 25% of what you would spend buying Tesla. Now you can take a look and see how much cash they generate. Now this is going to be in yen because Toyota is a Japanese company, and I think these are going to be in yen. Yes, all values are in yen. So you can take again a look at their free cash flow, which is negative in the past years, which is very unfortunate. They could be reinvesting, we don't know that, but you can just see how much this was. You could convert this to dollars and you can do some comparison of how much they make compared to Tesla. This goes back to looking at the competition, what they are doing. We know Tesla has been delivering 1.8 million vehicles in the past 2 years each. So 1.8. We know Toyota has been delivering 9.3 million. So you can just see the size difference. This is roughly 5 times as much, yet the company costs a quarter. So that's like a 20 times difference of like the price you pay and compared to the cars that your company delivers. So that is huge. This is probably a good article to read. It's more of a fundamental one, a foundational one. Not sure there's too much going on about Tesla, but more about the market. So if you're looking into Tesla or others, take a look at this article. We can see Tesla's sales are actually down in Europe. Again, drop again in February, the article says. We can see that Tesla's market share falls to 1.8%, down from 2.8 last year. That's not good. Tesla sold fewer than 17,000 cars in Europe in February, versus 28,000 of the same period last year. Elon Musk's involvement in the US government might have an impact on that, sure. And then the overall BEV sales are up in Europe despite Tesla declining. So Tesla is down in Europe, yet the market grows. So that is not a good sign for Tesla. They have to find a way out of that. And now here's another article from another huge market, which is China. And I don't know about you guys, but China, when I go on YouTube, I see left and right and center new Chinese EV car reviews. I don't know how much money the Chinese government has been pouring into local EV manufacturing. I read that it's a lot, and I've been seeing car companies popping up everywhere from China. So let's see, this article is about Tesla versus their BYD rival. So you can see this is a chart where they do car deliveries, I believe. Yes. And so we can see that BYD actually just overtook Tesla in amount of car deliveries. And this is in China. BYD reported a 29% jump in sales. And they also delivered 4.27 million cars. So it's a lot more than Tesla, which is interesting. And also, what I wanted to point out is that in 2024, BYD had a 32% share of China's total market, while Tesla only claimed 6.1%, despite reaching their best. So Tesla's market share, it doesn't say how it changed over time, but Tesla definitely has big time competition over there. And I think what you can see from the profit margin going down for Tesla, average of 5 years, 11.4 going down to 7.3 trailing 12 months, is a result of them having to cut prices. Because again, the Chinese car reviews, if you saw some, I get the impression that they do twice as more for half the price. So that is a very, very big problem for legacy automakers and Tesla probably to figure a way out of that. And if it's not tariffs that the governments are going to put on Chinese EVs, I think car manufacturers that we are familiar with are in big time trouble. So let me know what you think. Bring me other articles where Tesla is winning, and we can see what is the positive about this. There is one more thing I want to show you, which I worked on in the last couple days, and this is a DCF, a discounted cash flow analysis. So what this is used for is that you can take a look at the company's free cash flow and you can project it into the future. You can give it a growth, what you think it will grow by year after year, and you can put a price on a company based on how much cash it is going to give you. All right. I have space to put in more data. This is only just pulled from MarketWatch, so it's freely available. You can use whatever source works for you. This is the same thing that would the checklist on, and we can. What I would do here is I would take a look at whether this is sort of looks good, or if one value is really out of place. I might just go and ignore that value, but I think this looks fine for my purpose here. And this looks a rather wobbly line, so difference is not too big. I will use the average of the 5 years. You could do the last, which is the most up to date, but the difference is not that big, so I'll just use the average. Now the year by year growth rate is 45%, which is very generous. My model will halve that growth rate for the years 6 to 10 in the future. For the first 5 years, it grows by the same growth, and then it halves, and then into the future is just another formula that every model uses. Now what you do is that you find a discount rate, basically how much return investors want and how much the debt costs, because those are the two ways you can finance your business. And you're just gonna basically bring the future value of cash to today, so you know what price it is worth to pay for. You do this for all years and you get a sum of all these future cash flows, which is this much. You can calculate an equity value by adding the cash and deducting the debt. So you get what essentially is the business worth without all this that can be just done with. And once you get the number of shares, so you know how many ways you have to split it. Remember, Tesla issues a lot of shares, 31% up over 5 years. So you're gonna get a lot of competition to share this profit with. So this is actually gonna be worse. Once you do that, we come to an interesting value of $55. Now Tesla currently trades at $288. So this is a minus 80% based on free cash flows, guys. This is not good from a fundamental part. Now this does not mean that you cannot make money with Tesla. This just means that from a fundamental point, this might not be a company to invest in. Again, I might be overlooking something. Bring your own ideas and let's talk about them. But from a fundamental standpoint, I don't think there is much in Tesla at the current price. It would have to come way down in light of all the competition it is getting, in light of all the market share it's been losing, in light of the profit ratios that it's been losing. And so again, it does not mean that you cannot make money with Tesla, but it might be sort of a momentum play based on how people are feeling about the stock. I don't know about that. I stick to fundamentals. I like the numbers. I know how to work with them, I think. And so I think this is where Tesla is at right now. Bring your own ideas in the comments. If you have any other stocks that you would like to take a look at, let me know in the comments and we will take a look at them. Thanks for your time, guys. I hope you like this video and you could add something to your research and view, and I hope to see you in another video. Thanks. Bye.